Welcome to Schack Shorts, featuring the faculty of the Schack Institute in conversation with leaders in industry, policymaking, and academia.
Great. So this is Scott Robinson, professor of real estate capital markets at NYU. I'm here with Casey Conway, the red shoe economist. He and I both sit on the board of Monmouth Industrial, which is where I met him. I think it's been about 2.5 years now.
Two years, yep.
Yep, good. Casey is obviously a well-respected economist focusing really on manufacturing and industrial and distribution channels. But I wanted to have a one-on-one conversation with him to hear his thoughts about the market. You know, I think there were some still pretty good economic numbers coming out of manufacturing production, you know, going into this virus issue. But our containment efforts are obviously shunting supply chains and obviously, you know, shutting everything, the entire economy down for who knows how long. It could be 2 months, it could be, you know, 4 months, it could be sporadic over a significantly longer term. So I wanted to hear your thoughts about the economy, how long you think this might last, and what the post-economy or post-virus economy might look like.
Yeah, great, Scott. So, everybody wants to know, what's it going to be in our forecast. I think the best quote is from Winston Churchill back in November 1940 when he says, basically I'm paraphrasing, thank God God didn't give human beings the ability to have foresight, because we probably just couldn't handle it. So maybe that's where we are. So I'm in the camp that I think we're actually going to have a W-shaped recession. The V is what everybody thinks. It's a real sharp drop, and then we pop back up once we lift these orders in place, or shelter in place orders. I don't think that's going to be the case. I think that we're going to discover a lot of holes that didn't get plugged in the dike. We didn't have an earthen dam break, but we're discovering a lot of those. And so I think once the shelter in place orders lift, we will have some lift in the economy, but I think a lot of metrics aren't going to come close to recovery. We've already closed 50,000 retail stores is the latest CoreSite data number. It's estimated that a quarter from the NFIB, small business, that a quarter of all small businesses are essentially out of business, whether we've discovered it yet through their state document filings and whatnot. That'll be a big lag in the government data and the jobs data that we see. So a lot of these metrics are very lagged. We can't look at them. The jobs report came out Friday. Unemployment was at 4.4%. Contrast that with 9 million jobless claims. It just doesn't compute or correlate. Part of it is a lot of these metrics, we're not doing apples to apples comparison anymore. So when the CARES Act was passed, for the first time ever, we allowed 1099 employees and sole proprietors to file for unemployment claims. So that's why it spiked up so much. Otherwise, we wouldn't have seen that. And in the Bureau of Labor Statistics data, they still only look at it as if your benefits that you're receiving from an employer that's laid you off or whatnot, until those are exhausted, you're not counted as eligible to file for a claim. So huge disconnects. This is going to be a really fascinating time for all of us to relearn economics, go back to 101 school. It's also going to be a time where we learn about what are better new forward-looking metrics. So as you know, Scott, from our joint service on our public REIT, that I'm a big fan of rail time indicators. So what moves on the rails tells you what's happening with the economy. It's perfectly correlated to GDP. The American Association of Railroads just produced their March report. It was the worst number since they've been keeping data back to 1988. So no surprise when you shut down the global supply chain, manufacturing, shipping, that happens. But as we build this back up and we recover, it's going to be important to look at that, because as goes rail will tell you how quickly we're coming back out. The other one that I'm looking at that's going to be very predictive is the TSA passenger throughput metric. So I hadn't checked on this in probably a year and a half, but TSA keeps a count of all the passengers going through every airport every day. In the beginning of March, that was over 2.2 million passengers. It's now less than 100,000. So when you have, for example, in New York, Delta and American Airlines each canceling over 250 daily flights in and out of New York to like 10. We need to see how that restarts. And I think we'll see some uplift, but I don't think we go back to 2 million passengers on airplanes in June, July, or August. I think it could take us a much longer time. So I think we'll see a more of a W. We'll see a lift after the orders, shelter in place orders lift. Then we'll discover all the holes in the economy, what didn't get plugged, like 1031 exchange extensions, or the news today that I've been trying to promulgate about the carnage in university towns. We're sending all the students home and no programs. People forget that commencement season is about a third of all. That's Christmas time for small businesses in
Right.
university towns. So there's a lot of holes we have to plug.
Interesting. That's a really good point. Look, you covered a lot of ground there. Let's back up and talk about some of the keystones to the economy. So that unemployment figure, you're right. I hadn't really thought too much about it, including the 1099 folks. Any idea what percentage that actually is?
So I think honestly, when we get the numbers, we're going to be pushing 10% here in the May report for the April period. We're seeing the filings there. The BLS also hasn't given clear guidance whether they're counting, if you get these checks from the CARES bill, whether they're counting that as you're still receiving a benefit and you're not really eligible. So we don't know what the BLS, how they're going to calculate and factor that into the numbers. So that's why I tell people, I always was a critic of the government data. I always used to joke, I still do, BLS minus L equals what? Barbecue sauce. So I look at ADP or individuals that process payrolls. I looked at the LinkedIn workforce report. These are real-time big data, people that are processing payrolls. They're telling us what's going on. So I would look more at ADP type data or the LinkedIn workforce to help me out on the jobs picture.
Okay. Okay. And you had said you heard about 25% of, was it retailers or small businesses are closed?
So small business, so we have 600,000 small businesses, and about 25% is what the NFIB is suggesting we're seeing in the damage right now, that have already shuttered the doors, let everybody go. They're not even going to be eligible to get the PPP small business loan, that they're already gone. They've already let everybody go. So it's pretty
Wow.
tough.
Wow.
You think about it, the big thing we were talking about in retail was experiential retail. Probably the last thing we're going to go back to is experiential retail.
Yeah. Which is really kind of a triple whammy, if you will, for traditional retailers, right?
It is. And
Retail
think of
real
that
estate.
from the supply chain. If we go back and, have we done too much in China? Do we go through all the 1980s business school textbooks that I studied about just-in-time, management and inventory? That was the big thing from Lee Iacocca and all of those guys from my generation. Do we throw all that out? And now we don't look at just following cheap labor, but we take into consideration risk mitigation, whether it's a virus or some other risk. I think we're going to see a lot more risk mitigation variables in our supply chain equations. And just like after the 2009 financial crisis, when we shut down CMBS in 2009, I was at the New York Fed, and our friends at TREP helped us figure out how to stand that up. We called it CMBS 2.0. I think we're going to have logistics 2.0, the next phase of logistics.
So do you see, well, let me interject here a little bit. I've seen a bit of a trend globally, move toward nationalism. Obviously, we've seen it in certain political outcomes, but you do see that really across the globe, including the Middle East. Do you see this furthering that? And is that what's going to cause this kind of shifting in manufacturing and distribution nodes?
I do. And here's a warning for our students, go back and study the real root causes of why Japan struck at us at Pearl Harbor in World War II. We forget we put an oil blockade on Japan and choked off oil to Japan, and they felt that was their lifeline, like putting a tourniquet on them. So that prompted them to react. If we overreact on China and Asia, we got to remember the lessons of history. Sometimes these are what cause world wars and conflicts. So I think it makes sense that that we don't have everything, all of our pharma and all of our PP&E and everything critical to our economy made in one part of the world. We should have some of that balanced around, maybe with other allies and friends, and some of it domestically. But I think we've got to be very careful in an overreaction. We might relearn an unfortunate lesson that we forgot from World War II and Pearl Harbor.
Yep. Look, I was in New York during 9/11, and what I saw immediately after was financial services firms, disseminating and kind of distributing their platforms kind of away from the city while leaving obviously some core function in the city. Do you see distributed networks really taking hold in manufacturing and whatnot post-virus?
I do. Look at data centers. We don't put them all in one place like, Northern Virginia or Seattle just because they have cheap electricity. We put them in Dallas. We really diversify where our data centers are around the country for exactly that type of reason. I think we're going to discover that in logistics. I think one of the things that's going to be interesting to see is, do Amazon and other big logistics and e-commerce companies, do they continue to build these mega 1 million square foot distribution centers where if something goes wrong, that whole center and that whole supply chain is very disrupted, like what
Mhm.
was experiencing in New York with the problems around allegedly one worker testing positive? Or do we go back to multiple smaller buildings,
Mhm.
200 to 500,000 square foot in multiple places? I saw a news story getting ready to talk with you that Amazon's experimenting with a antibacterial fog in the warehouses to kind of kill anything that might be lurking in the packages and whatnot. So I think we are. I'll give you one other example. So the news this week was that Port Laredo in
Mhm.
Texas just surpassed LA Long Beach as the largest, busiest container terminal and port in North America.
Wow.
Imagine that. Who would have thought to forecast Port Laredo knocking off LA Long Beach even 30, 60 days ago? And so I think we're going to see, whether it's the manufacturing coming back and changing the way we supply chain, where goods move, we're going to see, like I said, logistics 2.0, whether it's Port Laredo, whether it's Port Freeport near Houston, which
Mhm.
GM and others were already turning to support Dallas, or Port Mobile. We just completed our terminal expansion to support Walmart is their Gulf Coast supply chain. There's going to be a lot of changes to this, and inland ports and how rail connects and how we store it. Do we store it, I think more like the grocery aisle. There'll be some family-sized boxes of cereal, and then
Mhm.
there'll be the smaller packages with the camping, variety pack. I,
Right.
I think we could learn a lot about logistics 2.0 by looking at the grocery aisle in the grocery store.
Nice. That makes sense. That's interesting. I know you're also a big fan of the Golden Triangle down in the Southeast. Do you see different geographies around the country and within states being impacted dramatically differently and kind of reshifting the landscape post-virus a little bit?
Yeah, so I think the Golden Triangle, which is really that, that area from really the Great Lakes and Midwest, down to Texas and then over down into Florida and up through the East Coast and Mid-Atlantic. If you look at that area is over half of it was over half our GDP. It was over 80% of all the new manufacturing announcements and distribution centers. I think that stays strong primarily for two reasons. It's the key infrastructure. It's the ports. So the ports in the Gulf and the East Coast give you better access, not only to the Panama Canal, but the Suez Canal in Europe. So if we have less emphasis on China and we want to maybe do more with our allies in Europe, that strengthens that area. Second thing is we only have 7 Class 1 railroads, and all but 2 of them basically move in that triangle, other than your 2 Canadian ones. And you got the BNSF, which is your horizontal line, and there's 2 T's off of that. You got the CSX line that comes up and connects into Memphis, and then you've got the Kansas City Southern that intersects with BNSF and goes down into Mexico. So you're not going to move those 7 railroads, and I think that will keep that anchored. But I think how we do things like inland ports,
Hmm.
Virginia was the first to develop it with Front Royal, and then South Carolina really figured it out. Now Georgia's doing it with 5 of them. These inland port models in highly dense population centers give you redundancy, and they're very different than on the West Coast, where you really have to travel inland a long way to cross mountains or deserts and go from California, really into getting across the Rocky Mountains. So I think those are the 2 key anchoring infrastructure elements that will keep the Golden Triangle very, very strong.
Okay. Okay. Look, we can get into the CARES Act a little bit, but I don't think there's a whole lot in there for commercial real estate. But there's already talk about an additional and maybe a couple more stimulus packages. Um, and I just lost my train of thought.
We'll talk about the
Oh,
getting in the CARES
infrastructure.
Act. Yeah.
Yeah, well, I was going to ask you, do you see infrastructure as being one of the stimulus packages that might come forward?
I hope so. And so I was fairly critical, but understood why we had to do the CARES Act. But when it got up to over $2 trillion, we were funding more wants than needs. And we ran that up by 800 billion to $1 trillion. And so for our millennial generation and Gen Z, you need to really dial in and make sure us baby boom generation doesn't wreck the rest of the economy for you. We are going to have a CARES 2.0. When Congress returns April 20th, they'll start in on that. I hope there's less wants, like, renovating the Kennedy Center, and there's more needs, like dealing with some of the holes we didn't plug, like looking at colleges and universities with all the students online and home, and the universities having to refund fees and housing and loss of revenue from, just imagine the NCAA. The NCAA basketball tournament generates more revenue for those universities that compete than their football programs. So these are big revenue losses, and they weren't in the CARES Act, and a lot of these are state universities and community colleges. If we don't want to wreck our primary education system, there's holes like that, which I consider needs, and we better focus on those than the fluff and the pork and the want. So, be vocal, I would say to everybody. Let your legislators and your representatives know, where's the beef from the old Wendy's commercial? We don't need any pork right now. We need beef.
Nice, I like that. Which is an interesting point. So you're looking for a W-shaped kind of recovery. I assume that's probably over a 18-month plus or minus time period. But aside from the timing, what are kind of the drivers to the two peaks? Is it more of pent-up demand on services and then manufacturing coming in the second wave, or is it more drivers on the downside with respect to virus containment?
Yeah, really interesting question, because if you look at it, even if you look at the ISM manufacturing index, they're not picking up how auto plants have been converted to making PPE equipment or ventilators. They're not picking up a lot of how factories are really being put to an alternative productive use. So manufacturing jobs, I think, are actually going to hold up. A lot of manufacturers, knowing how hard it was to get that workforce, are keeping them paid at the expense of other things. So example, Airbus down in our Port of Mobile just announced this week that they're closing at least through the end of April, but they're going to pay everybody because they can't find or afford to lose that workforce, and they'll know there's a disruption, but they're going to try to keep it intact. So I think manufacturing stays decent. What really gets hurt in this thing are those services industries, whether it's retail and restaurants and hospitality or air travel, even a lot of professional business services, that we're, think of dry cleaners, right? We're not traveling, we're not getting our suits done. What do they make a living on? Do we lose all the dry cleaners? So
Right.
I think we're going to discover that CARES bill got some of these entities through the first phase, but we were not prepared to go into really May. This CARES bill was only designed to get us into April. So we're going to need another $1 trillion or $2 trillion. And what I worry a lot about is, we had $23 trillion in debt going into this virus. We were on track for fiscal year 2020 to be another first year since 2009 where we ran another $1 trillion deficit, and that was ridiculous. The economy and the strength that we had here going into 2020 nowhere needed the kind of deficit spending that we needed in 2009. So now look what's happened in just 4 weeks. We've had $5 trillion of stimulus. We had the $2.2 trillion in the CARES, but people forget we've had almost another $2.7 trillion from the Fed.
Yep.
And, and for the students and people studying this, the Fed doesn't manufacture anything. They don't sell anything. They just call Treasury and say, print money. And the Fed doesn't take any credit risk. The Treasury takes that credit risk. So they print money hoping there's assets of value there, but we don't know. We haven't had price discovery in this yet. So we better be very careful. There's a great read I would recommend to folks. I've been doing, it'll make you stay awake all night, so be careful. It's a piece by John Lifflander, Lifflander. I think his email is something like jlifflander at gmail.com. I'll find it and send it to you. But it's a piece called How Monetary Policy Impacts CRE Values. It's a little misleading because the piece, written over a decade ago, is about the history of fiat currencies and the collapse of them. So the last one was Germany after World War II. People forget how recent that was and the experiment that failed there.
Yep.
Before that, it was China during the Song Dynasty when they removed silk from backing their currency. There was nothing backing it, and eventually it collapsed. And before that, it was Rome. The real root cause of the collapse of Rome was when Emperor Nero took silver out of the denarius coin, and there was nothing backing it.
Mm.
So we're running a fiat currency at these type of deficit numbers. We need to think about the inflationary effects. There's two causes for inflation. One is commodity and asset prices. We're seeing deflation in those. The other is the value of your currency. And if you have nothing backing your currency and your currency is just being printed to death, we could have an era like 1978 to 81 with Paul Volcker, where we see 21% prime interest rates again. I'm very worried about our fiscal cavalier mismanagement right now. And I understand the Fed's got to throw everything at it that they can, but we better be paying attention and again, dissecting those wants from needs and be careful here.
Yep. So that's a really good point, and something I've been emphasizing for my students as well. As a result, I've been a bit of a champion for real assets and real estate investing. What are your thoughts on that?
Oh, I think you're spot on that, you look at what's your ultimate protection from inflation, and it's real tangible assets. And commercial real estate, if you start putting the pieces together, I tell everybody, look at replacement cost. So even with lumber down 25% and oil down 50%, it's still more expensive to build an asset or a commercial property than what you can buy at a replacement cost today. So I'd look at replacement costs from asset price level. It's not getting cheaper to build this stuff. It's harder to get entitlements and zoning and all of that type stuff. It's really hard to do an adaptive reuse. Municipalities don't make it easy and make you bring up the building codes. So a piece of real estate is if it's income producing, that's real cash flow. And in fact, that's why I'm concerned about the 1031 exchange situation not being clarified or extended by the IRS. People think that that's a program for a lot of rich people that have, big real estate assets to trade. It's actually the average 1031 is less than $5 million.
Mm-hmm.
And what happened is with low interest rates the past decade, we've pushed retirees and baby boomers out the risk curve. They couldn't make anything on deposits or bonds. So they were forced to either go in the stock market or maybe go into real estate. So if, for example, they sold a second home and they said, I just don't have the income. I really don't want a second home. I don't need it. That's a want, not a need. I'll 1031 that into maybe a Walgreens drugstore or something that's a 15-year triple net lease, 10-year that can give me the income to get over the hurdle. That's the majority of the 1031 market. And they were doing that because they wanted the tangible asset and the income. So I think real estate really is going to be proven out again. And I don't think we're going to see the kinds of price declines long-term or even medium-term that we saw after 2009. There was no overbuilding, not oversupply. We were really, kind of building what we needed.
Yep. I imagine you all think there's going to be kind of a divergence on property types that would benefit from this, obviously based on everything we discussed on, retail being more negatively impacted, depending on what structural unemployment looks like. Workforce, lower income housing might be more dramatically negatively impacted. But what about work from home strategies? Do you see the office sector? I know you're not really an office guy per se, but are you seeing more digital and remote kind of negatively impacting the office market?
So I've got a real contrarian view here. People think I'm crazy, but we know that, right?
That's why we're chatting.
I actually think that when we come out of this, we're going to see one of the biggest surges in office leasing and absorption, because those of us that have been at home trying to work and missing companionship at a private office, we are really going to value our office space once again, and we're all going to go back to the office.
Really good point.
So I think that's my contrarian view. On the other property types, multifamily, I think it's important to segregate. Don't generalize, segregate within these property types. Workforce multifamily, I think, does fine. But student housing multifamily, I think, is going to get hit real hard, because most of these universities, as they sent the kids home, their off-campus leases and even the on-campus ones have act of God and act of university clauses that allow the students to get out. So I have two daughters, one in grad school, one in undergrad. They both lost their jobs, got sent home. We found those clauses in their lease, and we sent the last payment in March and said, we're done. We'll see if the university opens up again in August and September. I think we're also going to see a lot of these parents who's had their balance sheets destroyed through this thing again look to more online remote learning options, because we just can't afford to send the kids to the extra $5,000 or $10,000 a semester to live on campus. So universities are going to find an acceleration in online learning, just like grocers are as well. So I would distinguish those two property types. In retail, I would be disseminating or discerning and segregating between consumer staples and consumer discretion. So
Okay.
staples like a Walmart or a grocery store, a drugstore, they're going to do fine and come out of this very well. The discretion, like more a Target's really more of a discretion than a Walmart, and so I think they're going to get beaten up more and longer. And a lot of that discretion is also experiential retail, which I think we might have just seen the death of experiential retail, because I know I'm not going back to a gym or, a lot of the rock climbing wall. I'm going to be very guarded. It'll take a while to get me back going through the Atlanta airport with, everybody coughing and sneezing again.
Yep.
um,
Yep.
and then, the hotels, we're converting all these hotels in the urban areas to temporary COVID care centers and hospitals. How many of us are going to be very comfortable staying in that hotel unless we know there's been a complete retrofit and changing of mattresses and linens and every
All
soft
soft
fixture
goods.
in the
Yep.
hotel? So I think there's a lot of these pieces that we got to connect the dots to yet.
Okay. Interesting. But overall, you're still somewhat bullish longer term
I
on the
think
U.S. economy
so.
and real estate?
I do. I mean, it took us a long time to get over the excesses from 2009, whether it was leverage or overbuilding and the subprime that, people forget. Commercial real estate follows the rooftops. So leading up to 2009, we were building a lot of phony rooftops, and commercial real estate was following those, thinking people were going to be in there, and that's why it dominoed. And then we had all the leverage piece. Going into this one, very different situation. No overbuilding in residential or commercial. No real over leverage. Our bank's in a much stronger capital position than they were before.
Yep.
We have a Fed that gets it a lot more. They're applying a bottom-up approach this time rather than a trickle-down. Last time they gave the money to the banks and hoped they would behave well. What did the banks do? They choked off all the lines of credit. They contracted. This time we're putting the money in the hands of workers, small business, and hoping it'll trickle up. And the banks aren't contracting people's lines of credit. They're keeping them going because the Fed has told the banks, if you contract and act bad, it means more work for us. So we're going to give you a lot more leeway, and we'll figure those out as we go, but we're not going to criticize you. We'll give you loan modification guidance. We're going to do everything we can up front. So I think the Fed has learned a lot from 2009. I was critical of them when they started with just going to 0% interest rates, using the old tool, using a shoehorn to try to pound a nail.
Yep.
It just wasn't going to work. So I think they've got it right. I have confidence there. And we didn't have the imbalances. We had a strong economy going into this. And I'll leave you with one more piece of data to look at. The National Conference of State Legislators, the Pew Charitable Trust, just put a piece out where they updated how much money the states have on hand to weather a complete shutdown of revenue in their state.
Okay.
So the average was 48 days across the United States, and it was very, very bifurcated. So if you go to Wyoming, you can hang out there a long time, 397 days. They don't need any revenue.
Wow.
So if it all goes to hell, we're going to Wyoming.
Right.
Texas was over 100 days.
Okay.
A lot of the states in the Southeast and the Golden Triangle were in 40. But you want to look at the worst ones? Pennsylvania. It has a third of a day, 4 hours of revenues to survive.
Is that right?
Illinois, less than 5 days. So I would look at that data, the Pew Charitable Trust, and what they're doing in the National Council of State Legislatures, Conference of Legislators, and that information. It's also showing how quickly they're spending and planning to plug the holes. They're burning through it at a pretty rapid pace. I think those states in better fiscal condition with ample funded rainy day funds are going to be a better position to support their industries and do more than the federal government than those that don't. And those places, unfortunately, like Detroit or Chicago or Philadelphia, are really going to get hurt badly. And that trend we already saw from before this whole thing happened with the SALT tax impact. That was already happening and hurting those states. And now this just goes to an exponent. So I'd really pay attention to that.
Okay. Awesome. That's a really good data point to leave my students with. I appreciate it.
Sure.
Web address. How can my students follow you and continue to learn from you?
Yeah, so the best way, I put a good 2 or 3 things out every day on LinkedIn on my different posts. And so send me an invitation to join on LinkedIn, look me up. And I don't put what I'm barbecuing or who I'm I'm social distancing from. It's usually stuff like today, Port Laredo, or, this new Amazon fog thing, or this entity in Dallas, Texas that figured out how to basically convert hotels in 10 days to hospitals.
Okay.
Really cool, fast process there. I'll give you two others. All of my papers and podcasts that I do with the CCIM Institute are at ccim.com/insights, INSIGHTS, or some of them they're putting under, they have a COVID-19 separate page. So it's ccim.com/COVID-19.
Okay.
And then at the University of Alabama, we have our ACRE, Alabama Center for Real Estate. So it's ACRE, ACRE, at Culver House, all one word, CULVERHOUSE for the University of Alabama .edu. And so we have a whole thing there. I do a weekly Wednesday Insight that I get to have a lot of fun with. The one this last week may be actually, I think, one of my all-time favorites. It was called Dem Bones. And you might remember it. It was about the old spiritual song about the hip bone connected to the leg bone. We learned it in preschool and we forgot it by college. And I did that to draw the correlation that as we go through this virus, as we go through trying to recover and get the economy to stand back up, we better have a good perspective on the disarray of the bones and which ones have to connect to which ones. Don't get them connected right, we might end up connecting the head bone to something near the hip bone, and that might not be very good. So figure out the sequence of the bones, and that'll help tell you where we're making progress, where the gaps are, and where the casts need to be applied to get the skeleton back standing upright.
I like that analogy. I appreciate it.
Yeah.
Well, look, this has been really helpful. Lots of information here. Should give my students a lot to think about it and a lot for us to discuss going forward. So I appreciate your time, Casey.
Yep. Thank you, Scott. Good luck, and see you at the next meeting.
All right. Stay
Take
healthy.
care.
Be well. Thanks.
All right. Bye-bye.